While being slightly fast-paced, the markets are closed for the weekend. Tilray Brands Inc., trading under the ticker TLRY on the NASDAQ, closed the session on Friday, September 12, 2025, at a price of $1.12, marking a significant intraday gain of 5.66%. This recent uptick, however, belies a much more complex and turbulent reality for a company navigating the volatile currents of the global cannabis industry. The expectation for many retail investors, drawn in by the allure of a rapidly expanding market, has been one of explosive growth and mainstream acceptance. The reality, however, is a grueling battle against regulatory headwinds, intense competition, and the persistent challenge of achieving consistent profitability. While a single day's performance might spark optimism, a deeper dive into Tilray's recent activity reveals a company at a critical juncture, one where its strategic pivots and operational efficiencies will ultimately determine its long-term viability. Many investors looking at Tilray see a potential giant in the making, a dominant force in a future where cannabis is a staple of consumer packaged goods. They are drawn to the company's aggressive acquisition strategy and its expansion into diverse markets, including craft beer and wellness products. This narrative of a diversified global cannabis leader is compelling, but it often overshadows the more immediate and pressing financial realities. The stark truth is that Tilray has faced significant challenges in translating its ambitious vision into tangible, sustainable profits. The company's recent earnings reports have been a mixed bag, with revenue growth in some sectors being offset by continued losses and impairment charges. This tension between the grand expectation of market dominance and the stark reality of its financial performance is the central theme that will define Tilray's journey in the coming months and years. For those considering an investment, whether through platforms like Schwab Intelligent Portfolios or self-directed trading on Fidelity or Robinhood, understanding this dynamic is paramount. The recent upward momentum in Tilray's stock price can be partly attributed to a broader sense of optimism sweeping through the cannabis sector. Legislative progress, however incremental, at the federal level in the United States has a tendency to send ripples of excitement through the market, lifting all boats, including Tilray's. The recent approval of a bill by a House committee to protect state legal medical marijuana programs from federal interference is a prime example of such a catalyst. While this is a far cry from full federal legalization, it is perceived as a step in the right direction, a chink in the armor of prohibition that has long suppressed the industry's growth potential. However, it's crucial for investors to temper their enthusiasm with a healthy dose of realism. The path to federal legalization is fraught with political obstacles and is by no means a guaranteed outcome in the near term. The cannabis industry has been down this road before, with hopes of legislative breakthroughs repeatedly dashed. Therefore, to predicate an investment solely on the expectation of imminent and sweeping regulatory reform would be a speculative and potentially perilous strategy. The reality is that the current regulatory landscape, both in the U.S. and internationally, remains a complex and often contradictory patchwork of laws, creating a challenging operating environment for companies like Tilray. Those utilizing online investing platforms such as SoFi Invest or Interactive Brokers need to factor in this regulatory risk as a significant variable in their investment thesis. A closer examination of Tilray's recent financial performance reveals the stark contrast between its ambitious growth narrative and its bottom-line realities. While the company has successfully grown its revenue streams, particularly in its beverage and wellness segments, profitability remains an elusive target. The company's latest fiscal year-end report painted a concerning picture, with a substantial net loss, largely driven by significant non-cash impairment charges related to goodwill and intangible assets. These charges are a direct consequence of the company's aggressive acquisition strategy, a stark reminder that integrating disparate businesses and realizing synergies is a complex and often costly endeavor. The market's reaction to these earnings has been understandably mixed. While some investors are willing to look past the current losses and focus on the long-term growth potential of a diversified consumer brands company, others are growing increasingly impatient for a clear and credible path to profitability. This is reflected in the analyst ratings for the stock, which are predominantly a hold, with a price target that suggests limited upside in the near term. For investors, the critical question is whether Tilray's management team can effectively execute on its strategy of cost optimization and operational efficiency to a point where the company can consistently generate positive cash flow and ultimately profits. Comment below with your thoughts on whether Tilray's diversification strategy will be the key to its success or if it will prove to be a costly distraction from its core cannabis business. Delving into the specifics of Tilray's business model, it's clear that the company has made a concerted effort to move beyond its identity as a pure-play cannabis producer. The acquisitions of craft beer brands like Sweetwater Brewing Company and Montauk Brewing Company, as well as the expansion into the wellness space with products from Manitoba Harvest, represent a strategic pivot towards becoming a more diversified consumer packaged goods company. The rationale behind this strategy is twofold. Firstly, it provides Tilray with a more immediate and stable revenue stream in markets where cannabis remains heavily restricted. The craft beer market, while competitive, is well established and offers a more predictable path to revenue generation. Secondly, it provides Tilray with a valuable infrastructure and distribution network that can be leveraged for future cannabis product launches should federal legalization in the U.S. become a reality. This strategy is not without its risks. The craft beer market is highly competitive, and Tilray is going up against established players with deep pockets and strong brand recognition. Furthermore, the synergies between cannabis and craft beer, while conceptually appealing, are not yet fully proven. The company's ability to successfully cross-promote and integrate these businesses will be a key determinant of the success of this diversification strategy. Fidelity ETFs and Fidelity mutual funds, for instance, may have exposure to the broader consumer staple sector, and it will be interesting to see how Tilray's performance in the beverage alcohol space compared to that of its more established peers. Looking ahead, the future of Tilray Brands Inc. is likely to be shaped by a confluence of factors, both internal and external. Internally, the company's ability to execute on its cost-saving initiatives and drive operational efficiencies will be paramount. The integration of its various acquisitions needs to be seamless, and the company must demonstrate a clear path to profitability to regain the full confidence of the market. Externally, the regulatory environment will continue to be the single most important factor influencing the company's trajectory. Any significant progress on federal cannabis legalization in the United States would be a game changer, opening up a massive new market for Tilray's products and services. Conversely, any setbacks on the regulatory front could lead to further downward pressure on the stock. The competitive landscape will also continue to be a key factor. The cannabis industry is becoming increasingly crowded, with new players entering the market all the time. Tilray will need to continue to innovate and differentiate itself to maintain its market share. For investors using a variety of platforms, from Fidelity Wealth Management for their individual brokerage accounts to the more streamlined Robinhood app or SoFi trading platform, the key will be to closely monitor these developments and to be prepared for a potentially volatile ride. In conclusion, the story of Tilray Brands Inc. is a compelling case study in the tension between expectation and reality. The expectation is that of a global cannabis powerhouse, a diversified consumer brands company that will dominate the market for years to come. The reality is that of a company grappling with the challenges of a nascent and highly regulated industry, a company that is still in the process of proving its long-term viability. The recent uptick in the stock price, while encouraging, should be viewed in the broader context of a company that is still facing significant headwinds. For investors, the decision of whether to invest in Tilray is not a simple one. It requires a careful consideration of the potential rewards against the very risks warranted. It requires a belief in the long-term growth potential of the cannabis industry and a conviction that Tilray's management team has the right strategy to capitalize on that potential. Ultimately, the future of Tilray will be written not in the headlines of today, but in the financial statements of tomorrow. It will be a story of whether this ambitious company can finally bridge the gap between the grand expectations it has set for itself and the challenging reality it faces in the marketplace. For those with a high tolerance for risk and a long-term investment horizon, Tilray may represent an intriguing opportunity. For others, a more cautious approach may be warranted until the company can demonstrate a more consistent track record of profitability and a clear path to sustainable growth. The journey of Tilray is far from over, and the next chapter is sure to be as eventful as the last.